please give a warm welcome to Carol Alexander from the University of Sussex Business School for her presentation on future trends in crypto data and derivatives.
Thanks very much. I'm going to be talking about some papers that are out on the SSRN website. Those of you who know academic repositories will be very familiar with that. I just uploaded them at the beginning of May. And my co-authors are students that I work with, Michael Dakos, my second-year PhD, who's actually here in the middle at the back there. Say hi, Michael. A couple of other students and a master's student from Technical University of Munich. And so these three papers, I'm going to whiz through some of the more useful results for the theme of this particular summit. So three sections. First of all, talking about the quality of data. What is wrong with some of the data, not CryptoCompare. That's what's led me to this conference, in fact, because looking at other coin ranking sites like CoinGecko, we found some real problems. These feed into other market indices, not the MVS. I know there's a talk going on that at the moment, but some of the other market indices are basically wrong. And then I'm looking at the CME Futures. They have quite a leading role in price discovery. I won't be going through any mathematical models, although there will be some Greek letters on the slides. I'll just explain briefly what they're about, but just to show you that there is statistical evidence that these futures are playing quite a leading role in spot price jumps and how people, institutional investors, may be profiting from that. And then finally, I'll be looking at options on Bitcoin, looking at the Deribit exchange. Now, these data are very difficult to get, but we've used them to introduce something called the BITIX. It's like the VIX. You may have heard of the investors' fear gauge of S&P 500s. Well, we've constructed a BITIX, which is also a fair value variance swap rate. So then we look at the payoffs to variance swaps. I'm sure that OTC or on-chain products, maybe not in centralized exchanges, but on-chain products, smart contracts probably already exist for this type of thing, because there is one exchange, LedgerX, that has its own index. It's not the same formula as the BITIX, but they do provide, that's the first exchange that provides a volatility index. And then from that, volatility futures like the VXX notes, those of you who are familiar with trading equity volatility will know what I'm talking about. If not, then it's all in the papers. Okay, just as an introduction, and I can't actually use my pointer, so I'm just, because in the back it's probably difficult to see some of these numbers, but if you look at these numbers here, so here we have CoinGecko, CoinMarketCap, CryptoCompare. Now these are indices for Bitcoin, okay, so they're volume-weighted averages. CryptoCompare use currently about 40 different exchanges, but they only use the US cross rates, whereas CoinMarketCap, CoinGecko, they use about 400 different cross rates, including the tether rates. So they do Bitcoin Tether, Tether USD, but they also do Bitcoin Ether, Ether USD, to infer some sort of volume on Bitcoin USD. So that's a little bit difficult to do. A VWAP, volume-weighted average price, is almost impossible to get accurate volumes, not only when you're using 400 exchanges, some of which are involved in zero fee, wash trades and so forth. We heard about volume inflation strategies from Kin's talk earlier on, but it's not just the volume inflation that's a problem with these rates. There's also the fact that they can't infer a proper volume from cross rates. So just to illustrate how important it is, this is a simple, what we call single index model. So looking at some market index, this is the CCI 30, so this takes 30 Bitcoin, Ether, and other large cap coins, and uses some sort of weighted average of those coins. It's constructed a little bit like the S&P 500. Similarly, the CRIX, they use many more coins, and then the MVDA25, there's a talk going on about these indices at the moment. But they all use slightly different rates, but they are broad market cryptocurrency indices. And then we have an individual coin data. It could be from an exchange. I've chosen these exchanges because BitFenix, Coinbase, Kraken, and Poloniex are major exchanges. And of course, the Gemini one was intrinsic for the CBOE futures before they closed. what we see is that with the CoinGecko data, we get very different numbers, 0.374, 0.903, 0.35, for the market beta relative to the broad market index, whereas none of that is apparent on any of the others. They're all fair, as long as we don't use the, CCI 30 and up, they're all more or less okay, whereas, and similarly for Ether, it's even more obvious that there's something wrong with the CoinGecko data. When we saw this, we decided to look at the CoinGecko data, and this graph here just plots the difference, the relative difference between CoinGecko and CryptoCompare, Bitcoin and Ether data, Bitcoin on the left, Ether on the right, as a percentage of the CryptoCompare price. So you can see that there are anything up to 20% differences, but these differences suddenly started, these massive differences, on the 30th of January 2018. In fact, what happens is there was a data error. They have a slightly different timestamp. Instead of 23:59:59 UTC, they use the 0:00:01 UTC. So there shouldn't, it's only 2 seconds different. There shouldn't be much difference, but there must be a back office error or something. So if we then lag in this middle one, we've lagged the CoinGecko data, and again looked at the spread relative to the CryptoCompare price, we see that it's fine afterwards. So what you have to do if you're trying to use CoinGecko data is delete an observation on the 30th of January. Then it's okay. Unfortunately, there are 225 papers published using data such as this. We did a survey of those published in top academic journals, finding that less than 25% of these papers are actually using correct data. So from an academic's point of view, it's really important to look at the data that you're using. And then there's a CRIX index. There's a chap out in Berlin who's been providing this data, not only academically, but it's used for underlying products. And the error in the CoinGecko data feeds through to the CRIX index because they use CoinGecko data. So again, if you're going to use the CRIX index, you have to omit one observation, then it's all right. Now, what is the effect of the data that you choose, whether it's CoinGecko, CoinMarketCap, CryptoCompare, or any, I've just put a couple of exchanges here because we wanted to go right back to 2013. And these are the longer standing exchanges. So this is using Bitcoin daily log returns, to estimate volatility. And you can't just do a standard model like an equally weighted average or even an exponentially weighted average, as Riskmetrics data uses. The Bitcoin markets, other cryptocurrency markets, particularly Bitcoin, move so quickly that standard tools for risk analysis don't work on Bitcoin. And we had Michael spent months messing around with different types of models, ended up finding that not even the standard optimizers, the maximum likelihood estimation, doesn't even work. We have to use Markov chain Monte Carlo, Bayesian learning to get decent results that are fairly standard. And here we're using a two-state because, of course, there are regimes in the prices of Bitcoin. Student T, sort of normal errors with asymmetric response, and it's something called a generalized autoregressive conditional heteroscedasticity switching model. Okay, so it's very sophisticated. You don't have to know what these Greek letters are, but what you need to know, there are two states. And when we estimate the model on these data, in the low volatility state, it doesn't matter very much, but when we go to the high volatility state, it really matters a lot. So when it comes to estimating risk, you could come up with a high volatility state of anything between 115% or 216%, depending on the data that you use. Now let's focus on the individual exchange data, so Bitstamp and Kraken and some of the other exchanges, because although these data go all the way back to 2013, more recently it really doesn't matter what exchange you're getting the data from, as long as it's one of these better exchanges. And again, Quinn was talking about the better exchanges in terms of their AA ranking and so forth. And I've chosen these exchanges because Coinbase, Bitstamp, Kraken, and Itbit are in the Bitcoin reference rate for the settlement of the CME futures. And also Gemini used to be, the Gemini auction rate was the settlement for the CBOE futures. And you can see that since the bursting of the tether bubble, in the last tether bubble, let's say we're in another tether bubble at the moment, but in the last tether bubble, there's been, I mean, the spreads are down to less than 10 basis points, and when you look at it, unless you're always doing the making, you've got quite a lot of fees to pay if you're doing exchange arbitrage. Nevertheless, I mean, at the last crypto conference I talked at, I met a few people that are still running the arbitrage bots with some success. So, I mean, these high-frequency arbitrage bots trading between them means that it really doesn't matter which exchange rate you're using, as long as it's from one of the better exchanges. And so arbitrage profits from standard strategies, Bollinger Band type strategies, unless you're doing very high frequency trades, have more or less gone, except on BitFenix. So what you see here is just since April last year, and everything was fine until December, mid-December, BitFenix introduced margin trading on the US tether cross. So you can use $1 to buy, well, not 10 tether, but, you know, many tether. I think it's something like 3.3 tether. And then use that tether to buy Bitcoin. So obviously this is one way. Another way in which BitFenix are pumping up or down the price. So have a look at the price here. This is just when the BitFenix spread. I mean, there's something very odd going on in BitFenix because the triangular spread, Bitcoin tether, tether USD, Bitcoin USD, is out of line. I'm not quite sure exactly what's going on. We have to do some more forensic analysis on this, but you can see that this steep decline coincided with the decoupling of the BitFenix price. And then the recent boom, April, and then again more recently in May. And there are two, these are the BitFenix price adjusted for tether. So multiply BitFenix only do BitFenix tethers, but you multiply it by the tether USD rate. And in the blue line, I use the Kraken tether USD, and in the dotted line, I use the BitFenix tether USD, which is really out of line with the Kraken tether USD. So as I said, strange things going on with Bitcoin and tether on BitFenix. Watch this space, because I'm pretty sure that this is related to another tether scandal. Ether's much more robust, always has been. Okay, next bit. So, I hope I'm doing all right. No, I'm not. I have to be very quick. Futures, unregulated, regulated. We're hearing all about those unregulated futures in the panel just now. So we had people from crypto facilities now taken over by Kraken. These futures, BitMEX as well, ideal for hedging, very small contract size, 1 USD. And anybody trying to use these futures for hedging, the position risk is going to be much too large, because the underlying of the regulated CME and CBOE futures is, on CME is 5 Bitcoin, which can be quite a lot. So given that hedge funds only have about, maybe 10 million, no more than 100 million, we always talk about institutional investors, blah, 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 big hot air. Who actually is coming in to this space in the institution? Everybody's talking about it, Fidelity's talking about it, but there's no hard figures anywhere. Anyway, but what we are seeing is speculation. And there's clear evidence of speculation on the CME and on the CBOE futures before they delisted them. So this is just showing that CME took over the volume, and this is more about the specification of the futures. So big contract size, maintenance margin, 37%. Well, yeah, that's okay. 37% linked, obviously, very strongly to the volatility on the underlying, settled on the Bitcoin reference rate, and the CBOE futures, they are now no longer there. Anyway, this is just a very sophisticated vector error correction model that with information shares, so basically using 30-minute data over a long period, shows that the CBOE, the futures, were playing a very, very strong leading role before they were delisted. And this is just 1 minute data, just zooming in on April this year and also in May this year, where the CME futures, instead of not playing such a strong role, in those periods played a very, very strong role in leading these jumps in price. And this blue line is the basis, showing that the futures is above the spot, and of course when it's the other way, the futures is going to be below the spot. So zooming in just on these, the November and April, the paper does more details. You can see, for example, the correlation between the basis, difference between spot and futures, and the lag spot returns is 0.7 or 0.5 or 0.8. So it's very clear that what's happening is that you can take a position on these futures and then you can deal on any one of those exchanges. It doesn't really matter because the Bitcoin reference rate is of the 4 exchanges. So you can front run yourself and make very big profits. Anyway, I've got an appointment next week to talk to the CME about these results. Finally, BITIX. So looking at data on options is very difficult. We had to go to the Deribit API. Although LedgerX will provide some data, it's nothing like what we need because these markets are so fast. We need to take scrapes every 15 minutes. That's what we've done. So we just take out of the money options because those are the most liquid. And we're trading quite a range of strikes and maturities. And unlike S&P options, which the first maturity could be 3 months away, the maturities are anything no more than 7 days away. Same thing with the Ether options that they just introduced. So looking at the what we call the implied volatility surface from them, this is what it looked like in April, and in May it's gone up to, as somebody else was saying earlier on, implied volatility is around 90%. Well, it's either 120% or 40%, depending on where you are in the skew. But you can get one number called the BITIX, which is the same formula as the CBOE used for their VIX fear index, and that's the formula. It's based on work by Anthony Neuberger, by Peter Carr, by Dylan McDan. I won't go through how you get the formula, but it's the classic finance theory that gives you this formula. So you basically have a weighted average of these prices and those prices, and then you interpolate between the two. This is what it looks like. So you can see this BITIX. I've got 7 days up to 90 days of BITIX that in April jumped up to 80%, and then currently stand at around, it's gone down. This is up till yesterday. Every 15 minutes. Why are these useful? Well, this is the fair value for a variance swap. Variance swaps are OTC contracts, so obviously they have market price, but if you've got a fair value price that you can mark to model as well, it makes these products attractive and liquid. So a variance swap, you've got a floating leg, which is realized volatility, whereas in the S&P 500, you'd have to take daily returns. Here, because the market's so fast, you need to take like 15-minute returns. So this is the sum of the squared 15-minute returns. N is like over 7 days, it would be the number of 15 minutes in 7 days. So it's the sum of the squared returns. And then the variance risk premium, i.e., are investors willing to invest in Bitcoin volatility, even though it gives the variance risk premium is generally negative? This feature that you see here for the different term structure of the variance risk premium is almost identical to what we see in the S&P 500, except time is accelerated. But otherwise, it's very similar. It's normally negative, so if you issue variance swaps, you will normally make quite a lot of money, but then you're going to be hit with whenever volatility hits the fan. And that's it. And if there's time for questions, probably not.